Hello, ladies and gentlemen, PWM readers and viewers around the world. Welcome to our latest episode of The Tea Break. It is my pleasure to welcome back to these famous green sofas of the FT studio one of our regular commentators, economist, global macro strategist, and emerging market specialist Sharmila Whelan of Westbourne Research. Welcome back, Sharmila.
Delighted to be here, Yuri.
And what sort of tea have you chosen to drink today?
Why, of course, green tea.
Any particular reason?
With the US-China trade war, and given the US isn't known for tea, it seemed appropriate to get green tea then.
We were discussing in a previous tea break, Sharmila, that defines us as humans, the need to stop for a chat, drink a cup of tea, talk about issues and ideas, whereas these robo-advisors, they're just straight down their cables, processing the data. They don't need to do any of this. And this tech area, the digital currencies, this is something we've been analysing a lot recently. And we've been having questions from readers about it as well. And you very kindly agreed to answer some of these today. We had one from Alexander Bukowski, partner at the US wealth firm Veduta. And he notes that many family offices and sovereign wealth funds are taking quite substantial positions in crypto assets. As you've been writing, Sharmila, several currencies are battling for global supremacy. The US dollar, the Chinese renminbi among them. And while many wealth managers have perhaps ignored the crypto assets, despite it being backed by the White House and Donald Trump, should the wealth managers be taking the rise of Bitcoin and crypto a bit more seriously?
I would say definitely, but they've got to be strategic. I mean, Bitcoin or cryptos, it's a new asset class, and they should be a part of any well-diversified portfolio. But, cryptos have also got their downsides. The market is fairly illiquid, they're highly volatile, there aren't any benchmarks. So you need to be strategic in what you're investing in and really follow where the institutional investors are going. With regards to Bitcoin specifically, my own view is that the Bitcoin will become a US reserve asset before the end of the second term for Trump and probably before the midterms, because ultimate authority on deciding what type of reserve assets the US can hold, including the Fed, is Congress, and the Republicans are both houses, and Trump is a big fan.
It's interesting you said the ultimate authority on this is Congress, while some people might think the ultimate authority is actually Elon Musk, who seems to be having a huge impact on US policies at the moment. And we had a question from another regular contributor of ours, Malik Sawa, who used to be a former senior banker at Citigroup, now running the financial services arm of the Global Leader consultancy in New York. And Malik's asking about these non-state actors who are having increasing influence on governments and economies, Elon Musk in particular, through the Department of Government Efficiency in the US. Do you feel the actions of Musk and his like will significantly impact investments, including tech stocks, in the future?
The role Elon Musk has and the influence he's going to have and is having on Trump is quite unique. And I think there you've got an alignment of views and thinking, and therefore he's an integral part of this deregulation wave that Trump is unleashing, stimulating domestic industry, investment, growing the AI sector, and by removing the barriers in terms of regulation, compliance. And Elon Musk is very much a part of that. So, of course, it's very good for the tech sector, besides the 500 billion AI fund they're setting up, but more in terms of allowing that sector to grow. But I think the other place that he's, as we know, is having a massive impact is Dodge and the fiscal consolidation. And, that has got investment implications for pension funds and insurance funds, which tend to hold sovereigns simply because of asset liability matches. My view there is you're going to see massive fiscal consolidation, and US treasuries are oversold at this stage on the back of fiscal concerns.
The US economy had a major scare from DeepSeek in China. We're having a few questions as well from Asian readers about India, China and Singapore, three jurisdictions you know very well because you were stationed in the region for both Merrill Lynch and BP. We have an interesting question from Vanessa Taub. She's a senior vice president at Singapore's DBS Bank, one of Asia's rising regional champions. Vanessa will actually be joining us on Tea Break next week, so I think she wants to limber up for her role here as well. And she says most investors in the UK would probably never have heard of DBS Bank, while it's a household name in Asia with a valuation of around $95 billion. And she asks, should investors such as family offices in Europe also be diversifying across Asian jurisdictions to ensure safety and security of their assets, particularly when, as we can see today, there is so much political risk?
The jurisdictional landscape has changed quite a lot in the last 8 to 10 years. Previously, before the national security bill in Hong Kong built its reputation and built its economy and the financial sector by being a gateway into China. And investors preferred to go through Hong Kong because of the rule of law, independence of the judicial system. But ever since the national security bill, Hong Kong is just another city in China. And therefore, you want to invest, you might as well go to China directly. And Singapore is different because foreign direct investors as well as portfolio investors are still round-tripping through Singapore because, for protection. But that tends to be more for investments into ASEAN. Again, with India, it's such a big market, you need to be in India. The jurisdictional question is less urgent today when you think about India and China, because both countries, the governments are undertaking a lot of measures to make it an attractive destination for investors, whether it's portfolio or foreign direct investment. We saw that in India with the union budget on the 1st of February, where there's tax breaks, they've lowered FDI limits, opened up sectors, etc. And China's doing pretty much the same.
We had a question from Gumercindo Ruiz, a financial advisor from Spain. And this is one that I think that really separates the true economists from the tea leaf readers. He's saying we know a lot about the relationship between interest rates and stock markets, something that you're always writing about in your trading post forecast, but not so much about the effects of the reduction of central banks' balance sheets or quantitative tightening. Is this something you would look at as an investment expert when you're trying to forecast the behavior of equities and bonds?
I look at a country, see where it is in its business cycle. I've got proprietary indicators to track that, and based on where it is, I would make a call on whether you're going to be in equities or bonds, what's going to happen to FX and rates. It's about liquidity in the market.
And same for quantitative tightening.
And quantitative tightening is liquidity in the market. So if you look, for instance, at the Fed's balance sheet, the Fed and the ECB have been tightening very steadily. And the Fed's balance sheet is now about 23% smaller than it was at the peak in the pandemic. For the ECB, it's about 26%. So of course, that tightening is taking liquidity out of the market. But having said that, compared to pre-pandemic, there's still plentiful, liquidity is still plentiful. So for me, it isn't a huge risk that liquidity is being sucked out of the markets so quickly. There is no support for financial markets.
And at the moment, many financial markets watchers have one eye on the S&P and the other eye on the peace talks in Saudi Arabia. Both Russia and the US beginning to think about negotiations, while Ukraine and most of Europe are feeling very left out indeed. What sort of boost do you feel a potential peace settlement could offer to European economies and markets which have not been favoured for a while now?
Of course, Europe benefits from the reconstruction boom that will follow the peace settlement. And if you look at UN estimates, UN have estimated it'll cost about $486 billion over the next 10 years to rebuild Ukraine. But personally, I think that is a very thin silver lining to a very dark cloud. And the dark cloud here is signaling to Europe, if it hadn't already been evident, that the US is not a reliable ally. And that's going to feed their national security concerns. That, together with Trump's pressure on Europe to step up their contribution to NATO budget, means that Europe is going to see a big increase in defense spending, which comes at a time when they are fiscally constrained, which is a big negative for Europe.
So the US not a reliable ally, but a very reliable investment destination, would you say? I mean, we've had several articles about people diversifying away from the Magnificent Seven towards the Six Tigers of Hangzhou in China and towards some unloved European stocks. In your forecast, would you say that's a mistake, that it's still the US that investors should be concentrating on?
One thing that has come out of this trade war since Trump 1.0 is the speed at which China has indigenized, and they're moving in leaps and bounds. So I would definitely buy Chinese tech stocks. In the US and Europe, the rest of the world, I would be looking at, rather than the software companies, and therefore the Magnificent Seven, I'd be looking at tech hardware companies and AI hardware providers. But more generally about the stock market performance, I do expect the US to outperform based on my forecast for the economy, also my expectations about Trump's domestic policies.
Well, I don't think there's any danger of you being replaced by a DeepSeek AI avatar anytime soon. And I'm afraid that's all we have time for today. And please keep sending in your questions, ladies and gentlemen, and I'm sure you will all join me in thanking our special guest, economist Sharmila Whelan, who puts out her regular trading post forecast. And I look forward very much to speaking with you all in next week's episode of our PWM Tea Break.